Turnaround Tuesday, Warriors. How's everyone doing? For those of you that do not use ForexAnalytix, just a look at some of the patterns in play. Greg has got 10 bucks made in gold. A little edge here in Euro Aussie by Blaker. Greg has got a nice trade going in Euro, already up about 130 pips. Stelios has a very good trade going, just one little negative, 20, 30 pips. And then some closed pattern in plays. We're all pretty successful here, here, and Greg is kind of a wash between his two S&P trades. So a lot of great ideas. I would say, you know, most in the business say if you trade at least a 3-to-1 R to R, all you really have to do is be right half the time. You know, if your risk reward is 1-to-1, you have to be right a lot more. But anyway, I would say this is better than 50%. So if you haven't yet, you could consider taking the trial. There's a link there. Test drive our traffic light page. Don't run red lights. And you know, there are red lights, there are green lights, and there are yellow. So you could test drive it for $1 for 10 days. I think after 10 days, you'll know whether or not it's for you. Okay, so I want to start off when we get to the markets, and we're going to do that right now, is tip my hat to Blake yesterday. You know, we all kind of thought that the dollar had peaked last week down here. Greg had caught a pattern in play here, and then yesterday Steve and I were talking, well, yeah, it could dip one more time. This was a Spanish election, we'll pull back to get, and Blake said, without any doubt, pure conviction, I'm long Euro. Okay, so he was long Euro. He thought it would be supportive for equities. It was a huge day up in equities. We're getting follow through here in the Euro. To me, it looks like new highs are probably a layup now. And you look at your daily, if we had one more shot up towards 126, we'd have one of my favorite patterns would be unfolding up there for a potential third drive to a top. Perhaps Dixie trades a shade under this 88 level. Maybe we get a throw over. But we did identify this day as a peak. I believe it was Thursday when the market started selling off pretty dramatically. So Blake's dollar bearishness was definitely compensated for by his conviction on long Euro. I don't know, I'd say between 60 and 80, probably 80, 90 pips now, if you took it from when he was talking about it yesterday morning, right about this time. So here we have the S&Ps. Yesterday I said like a 2-day rally to reestablish bearish positions. I'm going to do that today in some ETFs, bearish ETFs. I wouldn't want to see the S&Ps close back over, say, 2760 would tell me we're on our way, maybe even to new highs. You can't rule it out. So if we're going to fail in the S&Ps, we have to do it, I believe, between here and 2750. Shouldn't close 20 handles better than this. And then I also said that there could be another shorting opportunity in the crude oil market. We've had a nice 2-day rally. It started Friday. Not sure if we're going to try and clean out stops above this high yet either, but turnaround Tuesday, my shorting candidates would be this. You know, we all know that Canada's been on fire until right now. So I'm not sure if it's news related or just dollar weakness, but a big break in Canada. I wouldn't chase this break here. We didn't quite get to the 131 level. Aussie's acting great, you know, Aussie and gold. And something else that I saw last week, I thought we had stop hunts in the precious metals. It was the same day that the dollar peaked. It was this day in gold. Took out this low, closed above it. And a lot of analysts I know are looking for 1400 on this move. So if the dollar index is going to 87-ish, they're projecting another 70 bucks in gold. Silver actually even acting better. I think it is the last few days. Maybe we're going to finally get some outperformance, bullish targets in that I've been reading about in silver could take it up to about 18. Back to these highs again, 18 and a half. So remember, I think we have a lot of risk events this week. ECB, if I'm correct, BOJ, if I'm correct, and NFP, I know for sure. So I think the other two central banks are also part of it this week. Great call in Euro, Blake.
Hey, sorry, Dale, I'm here. Thank you.
It's okay.
How's it going?
What's that?
Dale, can you hear me?
Yeah, I could hear you, buddy.
My internet has been kind of choppy the last couple of days. I don't know if you can tell, but I can tell everything's.
Yeah, you're breaking up.
Am I breaking up right now?
A little bit. Yeah, just a little bit. Not terribly.
I've got to reset my routers and everything. Every once in a while, they need a flush.
Maybe that lady drove into your. Oh, the one that knocked your water out.
Knocked my cable box out. Yeah, that was.
Oh, yeah.
Yeah, you know, so we're obviously getting a little bit of a big move off of this North Korean news. You know, they want to have some peaceful talks and talk denuclearization, and so that's helped out risk appetite. So we've seen. I just got finished closing out some yen. I was short dollar yen at 106.35. I'll pull everything up here.
You still long the euro, or did you just scalp it?
No, I just scalped it, and okay. I've been playing. You know, I've been playing it fairly safe recently, and you know, and I was just the dollar yen here at 35. Just closed that out a few seconds ago, like 20. Where I closed out. Let's see here. I closed it out at 20 actually, and then I shorted the euro yen at 92 and just closed that out because I wanted to kind of focus on you know, the webinar here, and you know, I was short the dollar Canadian overnight. If you use ForexAnalytix, so last night, you know, I was writing this technical analysis, end of day technical analysis. The U.S. dollar Canadian managed to hold below the critical 130 level, and the risk reward would favor shorts as long as we were below. Break higher could see a move to 130.75 fairly quickly. So I'm like, okay, well, I shorted a dollar Canadian last night at 129.75, and you know, I was short, put my stops above like 130.17, I think is where I have my stops, because you know, I was you know, playing the, well, if we break through this, you know, big resistance, then we are going to push up pretty quick. You know, it's worth taking a, you know, a short right now from a reward standpoint. So I shorted it, and when I got up this morning, you know, the dollar Canadian was slumped a little bit. Right through here is that North Korean news broke, and I'm like, oh, you know, that was a quick. I think I closed it out at 40. You know, I made it like 35, 40 pips, whatever it was, and this thing just, the bottom fell out. It went a lot further than I thought it was going to, and we just, you know, basically stopped out a bunch of traders. You know, there were probably late longs. You know, they all got stopped out, and I missed a lot of this move. You know, I missed a good, I don't know, 60 pips. You know, I'm sitting here going, oh, you know, like, oh my gosh, what a wussy I am, you know, not sticking around. But, you know, I made a little bit, and you know, I've just been, you know, taking some profits off the table here and there, not, you know, nothing big. That one I had pegged, right? You know, just when I got up, and it, you know, 7 or 8 minutes had already passed by the time that North Korean news came out, and I'm like, okay, well, why haven't we seen a bigger reaction? I'm like, well, I guess that's all we're gonna get. And you know what, I should have done, just stuck around a little bit longer for, you know, all the North American traders to really sit down and go, oh, I need to get out of this dollar Canadian long, which, you know, I just wasn't patient enough. If I would have just stuck around like another, you know, 15, 20 minutes, this slide really started.
I have a question for you, Blake, because, you know,
Yeah.
That's one of my shortcomings, is leaving. I make the tough money, you know, while it's turning, and, you know, then I book it. I kind of call it first daylight syndrome. Have you ever used like some type of mechanical trailing stop on like a portion of your position so that you don't take yourself out of the trade, the market takes yourself out of the trade?
I usually don't. I don't use trailing stops very rarely. I have to be like, if I would have stuck around, see this is I'll show you exactly where I got out. You can see it pretty clearly here. I got out like right here.
Yeah.
Right.
Yeah. So for a candle, it looked like the right thing to do.
Yeah. And
right.
I'm like, okay, well, the news came out, and it came out like right here, and we just didn't go very far. I'm like, oh, you can see the support zone through here, all this red support zone. I'm like, okay, well, that's all we're gonna get. And I if I would have if I would have got up 15 minutes later, it would have been a different story, And then if I was short from here, and then I'm this profitable at this point, I might have actually put in a trailing stop, saying, "Wow, that was that now I can really stick around." And
well, I know that some people use these mechanical ones. They're not discretionary. That once they're in a position, every time period it kind of moves down or up to protect the position, and that way it takes all the you've done most of the subjectivity discretionary trading by picking your entry and defining your risk and having different targets. But I'm just saying that I'm considering doing that because there's so many times I leave a lot of the easy money on the table. Do you know what I mean?
One of the problems that I have, and this is the problem with in particular, not necessarily you guys listening at home, I'm in front of the computer a lot. I mean, if I had to measure my time that I spend in front of the computer, it's probably north of 14 hours a day.
That's including your phone, right?
No.
Oh, okay.
No, because when I'm not in front of my computer, if let's say I go run an errand, or I'm in the bathroom, or wherever I'm at, even around the house, a lot of times, because for those of you that don't know, I work out of a home office because my office is in Connecticut. I'm mobile, so I spend, but being in front of the computer, the problem is that I see all those small moves, and so if a move happens and it's in my favor, I'm more apt to take profits really quickly. Where if I miss something and I do a lot of order placements overnight. I put a lot of orders out, if the euro dollar gets, if the euro dollar gets here, and I'm not saying that I'm short right now. I'm just, if the euro dollar gets to the 618, I might put a sell order. If I was really bear the euro, but I'm not. But I'm just saying, I might put an order out there and then get triggered, and then I wake up and I might be up 30 or 40 pips, and then I can start managing trade a little bit more, a little better. And every once in a while I get in a lucky position where things moved really aggressively for me at night, overnight while I was sleeping, and then I can put in a decent order. But most of the time that's just not the case. So if most of the time I'm just not put in a position where I'm like, oh wow, I just made a quick 100 pips. So now I can put in a trailing stop, and a lot of guys and gals have noticed the difference in my trading over the last, let's just say, 5 years. I really started trading a much larger amount. The funds I've been trading that I don't stick around long term like I used to, because when I was a retail trader, I could sit in, I could buy $100,000 worth of currency, and I might be looking for 100 to really like 200,000 or 300,000 currency for myself, and I might be looking for a 100 move, and 100 move, I might make $1,000, I might make like $3,000, or something like that. And I'll be more willing to sit in a bigger move for that. But now I'm trading such big multiples of those numbers. For me, it's like, okay, I'm up 20 or 30 pips, and I'll take it really fast, but I'm trading big multiples of those previous numbers. So, I tend to be a little bit more trigger happy and a little bit more quick to take profits, but also quicker to take losses as well when trading larger amounts. And so I don't put myself in those situations as often as I used to in the past. Does that make sense, Dale?
Yeah, because first of all, with trading those kind of trading size, that profits accumulate so fast, and what you were used to booking and what you're booking now, is such an exponential difference that you never go broke taking profits.
No, I'm also in the camp, Dale. Okay to be wrong. It's not okay to stay wrong, especially when you're trading large amounts. So, for me, let me give you an example. Like let's say I buy like a couple million euro dollar, like 2 million euro dollar, let's just say, and it dropped 20 pips. I'm down 4 or 5 grand pretty quick. And so for me, I'm gonna sever that loss pretty quickly, because I don't want that $4,000 or $5,000 loss to turn into a $20,000 or $30,000 loss, because I'm going for 100 pip gain. I'll just cut it. I'll just cut my losses quickly and try to find a better entry if I think it's still moving lower and I want to pick it up at a better price. So I'm more targeted with my entries. I'm more I'm not as lenient with a position against me 30, 40, 50 pips. But again, when I was a retail trader, strictly retail, just trading for myself, that was okay.
Well, how about this, Blake? As a retail trader, you needed the bigger moves for it to make a difference in your life. And trading for fun, they have different expectations. They are happy and do cartwheels with 25, 30% returns on their money.
Yeah, what I'm doing is I'm really just kind of harvesting small moves and capitalizing on those with bigger position sizes, and that's
and they're happier with a lot less than most retail traders are. But most retail traders aren't happy with 25% on their money with a $20,000 account.
Yeah,
big deal. I made 5 in a year.
Right. It's a much different expectation and mindset. So and like I said, the people that trade in our chat room have noticed a much bigger difference in the way that I've been trading over the last, and that's predominantly the reason why. And what's that?
If it isn't broke, don't fix it.
Right, exactly. Yeah, great point. Anyway, let's talk a little bit about expectations for today, because they're a little skewed at this point. I have to admittedly tell you guys, I'm not 100% sure what I want to do at this very moment in time. I will tell you that I am bearish the dollar, which as you guys probably imagine and understand the reason why. We've got what I had been expecting happen is we had this false breakdown in the euro. We were challenging the underside of this trend line. We're hitting our head right up against all the resistance. We broke today, so the euro broke above that 123.65 level, and frankly, that's where I want to be a buyer of the euro. We are at 618 retracement, so I'm not very comfortable at this moment in time buying the euro, knowing where we're at, knowing we're here. I am looking for this today. I am looking for a dip in the euro dollar, and then I'm going to go long. Okay, I do think we're going higher here in the euro. Now it's just it's trying to find a better point of entry. I don't want to chase it up, because I woke up, this had already been taken, and I missed out on this huge move here, and I didn't want to I didn't want to chase the market higher at this stage, and I still don't. So now it's just looking for pullbacks. It's like, you know, okay, I know what I want to do is just, you know, get a decent price to get back in. Here, let me go back over here. So if you see the cable's made a nice rally, and we're basically doing what I thought we would do in the cable. We're almost at the 618 retracement. I thought we would fade up here, but I'm not in the camp that I want to be long dollar. If I was a dollar bull, I would be shorting the pound right now. I'm just not a dollar bull. That's the big problem that I have at this very second in time, if that makes any sense. The Aussie dollar is squeezed past some resistance here, downtrend line. Kiwi dollar has done the same thing. I think the Kiwi dollar has got a nice little setup here for, you know, possible short coming up in the next, you know, next 30 or 40 pips, which makes sense if the market turns lower. And by the way, let's talk about stocks real fast. So the S&P has had a recovery the last couple of days. If you watch the, you know, the weekend video, I explained that the dollar looks, or the stock market looks pretty strong, like we're going to get a continued bounce. We had a hammer on Friday, right? So we had this nice little hammer candle on Friday, and we've rallied, and we're challenging the 618. I don't know if we're going to go much higher than this. I think, and it is Tuesday, right, Dale? What happens on Tuesday?
Yep. Turn around.
Yeah, we might get a little bit of a turnaround. We might get some profit taking after the last couple of days worth of a rally. So I don't know if I'd really want to chase the markets up here. Now that poses another issue. Okay, if the stock market does, let's say, turn where we're at right here, let's just say today is it. You know, let's say we turn lower after today. Everybody goes, oh, you know, why the hell was I buying stocks this morning? You know, it's not the North Korean news. That's a big, you know, changer. Would just reduce a little bit of risk, but the stock market actually ends up turning back around again. Well, if that's the case, what happens to the dollar? Does the dollar strengthen? I don't know if the dollar necessarily strengthens against every currency, but the dollar might strengthen against, you know, the commodity currencies, against the Aussie or the Kiwi, you know. So we'll have to see what happens with equities. The dollar Canadian, you know, we had a nice little sell-off. I'm really not too sure what to do with the dollar Canadian, other than, you know, it gets, not necessarily today, because if you think about this, let me grab the pen again, and let me change the pen color. Okay, no, this is fine. I think this is green. Let's say we rally back here, and this candle turns green, right? Like this. And it has this long wick. I don't know if I'd really want to short the dollar Canadian. If that candle turns back to green by the end of the day and we close near this, you know, 130 level, I don't know if I'd really want to be short. That'd be a pretty bullish candle. So what I'm hoping happens here is that, you know, we see stabilization, maybe a rally up here over the next, you know, day, and then we fail again at the 130. It might give us an opportunity to sell up here, but I'm not really too sure what to do with the dollar Canadian at this very second in time. Swissie's kind of off my radar at the moment. The Nordic currencies, you see that even the US dollar Swedish krona is turning lower. I know on Friday I tweeted about the US dollar Swedish krona challenging this 161% extension. Has come off since then. And you know, like I said, Dale, I'm a little undecided what I want to do at this very moment. I'm just not super excited about anything, because I missed a lot of the overnight move. Even though I took some profits and I made a little bit of money, I feel like I missed the move. So now it's kind of, if you did, you're already out, and you know, you're looking to reestablish positions. Now I think you have to kind of wait to see how the market opens and see where to establish it. It's not that clear at this moment, and you know, and that's the thing about trading, is there are a lot of times throughout the course of the day or the week that you know, that there's a lot of time.
Yeah,
things are not clear. You know what I mean?
Yeah.
And they're not clear, but they do become clear. At least for me, they become clear at certain points. So, you know, if they're not clear, it's okay to stand aside and kind of, you know, wait for a good setup. I will tell you that I'm still long the Euro Aussie. The Euro Aussie is coming in a little bit. After hitting the 127% extension, I took some of my profits yesterday of 159. I'm looking to add back what I had been selling because I think this is going a lot higher. And if you do think that the stock market is going lower, the Euro Aussie is probably one you want to be long, because this one will continue higher if the stock market does turn lower today. So that's kind of what I'm thinking right now. And like I said, it's a little not easy at the moment, not clear. So with that being said, I'm going to turn over this murky mess to Steve and Stelios so they can try to make some sense of this. Good morning, Steve.
Hey, Blake. How have
Hey,
you been,
good
mate?
morning.
You know, Blake,
Good.
I think that a lot of traders need to take the pressure off themselves and say something like this. I miss trades. I miss trades every day, but it's okay. There's always another train coming around the corner.
Yeah, it's like
Take the pressure.
you know, I was trying to explain to people, trading's like, it's like sitting at a bus stop. You know, and you're sitting at a bus stop. If you miss your bus, there's gonna be another one coming around on that route. You know, you might have to sit around for a little bit. You can jump
Go
off.
have a beer and a sandwich and wait for the train.
I don't really know if I recommend that. Not while you're trading. Maybe if you're waiting for the bus, it's not a bad idea. But you know, there'll be the ride coming around soon. And same thing with the market. There's going to be a good setup developing, I'm sure. Yeah. So you guys, good luck today. Steve, good luck. Good luck making some sense out of this this mess this morning.
Thank you, Blake.
If anyone.
All right, guys. I got to get back over to trading. So I'm going to pass it over to you.
Steve,
Thank you, mate. Have a nice day.
Out of anything.
Not really, but you know, the good thing is that I don't have a problem staying on the sides.
Pretend.
Yeah. No, I just don't have a problem staying on the sides, and you know, as long as something doesn't feel right, or you know, I'm uncertain about something, because you know, it's absolutely okay, isn't it? What isn't okay is to try to be trading something that, you know, at the moment doesn't make much sense.
What do you think about fading the stock indexes on this day and a half, 2-day recovery? Well, really, it started Friday. What do you think?
I honestly have no clue. As you remember, I was adamant about one thing, is that I expected a reaction. You know, when we got one, I didn't expect that the S&P would penetrate the 2,803 level, the 78.6. But as I had been saying since we found a double bottom, really for me there are two scenarios here. One of them involves some choppy trading between the all-time highs and the double bottom. And the second one is another move to the downside towards the 2400 or 2480 area. And, you know, I think that trying to predict which of the two is going to happen makes no sense. It can be either of those. And, you know.
Yeah, I was just wondering if you know, recommitted to the short side. No, you were short for the last week. You caught that break last week.
Yeah, and unfortunately, the other half of my short position didn't get limited out just for like 5 handles or whatever it was. So I'm still holding. Yes, so I'm still holding half of my position from 27.44.
Okay.
And you know, I'm probably going to cut it loose if we go above 27.50. So at least I can get some profits in that as well. It would have been nice if we actually had hit the 26.40 area, because you know that would have been the perfect trade, because I would have taken half here in this support area as I did, and then the other half there, and that would have been nice. So I'm still holding half of it, you know, but I might only book like 20 handles of profit in this half. Depends on what happens from here. But you know, as we are seeing some risk appetite, there's no question about it, and I can't exclude like the push higher to resume like for this week. As I said, I think we might find ourselves in some choppy trading conditions, in which case I don't want to participate anymore. You know what I mean? I'd rather get more clarity than trying to be short or long something that will just be oscillating and sometimes violently.
How about euro? Yesterday you said you wanted to see some more confirmation. Did today give it to you?
Yeah, the fact that we actually broke above this channel's support that could have acted as resistance, it's quite important, isn't it? So, the chances of a push to new highs with this 38.2 retracement having been all that was to be for now seems very, very likely to me. So, wouldn't surprise me to see a push to new highs from here. So the chances, for a push to new highs have obviously increased quite a lot. So, anything, 21, 26, 127, 128, it really won't surprise me. RSI is also testing now a descending trend line here. So definitely. Anyhow, if you remember, I never stopped being constructive Euro USD and cable for a long time. I mean, we said that we might get some small corrections, but the uptrends have not been violated.
Never did anything wrong. Corrected more in time than price. Most corrections.
In most cases, even in this case here, Euro USD, that was mostly correction in time as well. If you look at it, took so long to retrace so little, right?
Yeah.
Same thing here. This looks like a flat to me. So yeah, why not a push to new highs from here? Very likely, more likely than a push lower. But even if we did see another push lower for a more complex correction, I would still remain bullish, because even if we saw like an orderly push to new lows, I would still consider this a choppy corrective price action than anything else. So I think that we haven't seen anything both in the euro and in the cable, because look at the cable. This is exactly what we were expecting here as well. Huh? You remember how long ago we drew this, that even if we push lower from here, so what? Just look at this move, right? Textbook corrective so far. We actually tested this broken channels resistances as support. We might even, we have satisfied one more low here, so we might not even make it down to 136 at all. This might have been a tradable low, this one. We're going to know if we get back to this trend line. So, why not? Why not a push to new highs from here? I see no reason why not, honestly.
Thank you, buddy. I appreciate it.
Okay, have a nice day, guys. I'm kidding. Okay, so let's have a look at the Aussie and the Kiwi. Blake didn't have a look at those. Beautiful reaction from the Aussie, from the 77.40 area. That's why this was an area that I had. This was the area I had set my limit order for half of my position. So I got limited out of half of my position. I'm still holding half of it, but in all honesty, as with the S&P, I will obviously not let the other half of the position go even to break even. So if I see this strength persist, which this is a very nice reaction after 2 hammer candles and some nice warning, I can't exclude it. I'm going to book profits on the other half and call it a good trade. So this is the situation with the Aussie. Let's have a look at the Kiwi. Very nice reaction here from the Kiwi as well. I wrote in the week in the weekend analysis that the Kiwi had the potential of a double top, but to get confirmation for that, we would need to break below this range, because in essence we saw a double top and now we're seeing a double bottom. What does that make this? It simply makes it a range. And as long as it remains in a range after this move higher, wouldn't even surprise me to see a new push to new highs. I would really want to see that area break down, for further weakness. But the fact that I wanted to see that doesn't mean that I'm going to force myself to hope in viewing this as a possible outcome, right? So, there's not much to do here. But obviously the case that we found support once again in this area, tells me a lot. Tells me that at least for now, the market is not ready to be bearish. So, at the very least, just neutral for now. And as I said, neutral after a strong move higher, increases the chances that when we finally get a breakout of this range, might be to the upside, right? So that's the situation with the Kiwi as well. I'm going to very briefly have a look at the CAD because Blake covered it just fine. I was viewing this move out of this descending wedge, as quite a strong move after we got the initial reaction from the first correction, and it's also very nicely channeled. I wrote yesterday in the chat room that be careful, 130 is a zone that can create a reaction. We've seen a very nice reaction so far, but as I wrote to the chat room when we were first, before we saw that much of a weakness, I said, pay attention, 121 and 129, and 128 are possible support zones, and I would really want to see the USD CAD push higher, but from either of these zones, like from 129, even more preferably from 128. So, even if we see a little bit more weakness here, this is one of the few currency pairs at the moment that I'm seeing the dollar quite constructive. So, I think that like something like this is quite likely, right? Before we then see a stronger move to the downside, because I do believe that the USD CAD is not going to run indefinitely to the upside. I'm viewing this as a correction, and as I was saying yesterday in the chat room, that might have been actually the day before yesterday. It doesn't really matter. We have a very nice zone here. Why? Because we have the 61.8 at 130, 130, but we also have, if you project here, this extension from the lows here to this high, and then you project it from this low, we have an equality target at 131. So the 61.8 is, this little area, let's say 30 pip area, is a nice confluence of resistances. It's not only the 61.8 fib from this move lower, it's also the extension of equality from the first leg higher to the second leg higher. So I would really, really like to see a move to 131, 130, 130, and most likely I'm going to be getting short there, unless, of course, I see the market like slice through that area like it isn't even there, because you never know, that can happen. But my initial plan is if the USD CAD behaves properly here, I'm going to short half of position and then keep some dry powder, another, half a position to either short it here, so I can increase my cost average to around 132, or if it actually does get rejected from here, I will probably add the other half at a break below 130. So, I know where I'm going to put my first half in, but I don't know yet where I'm going to put my second half in, because it will depend on how the market plays out from there. Okay, so, but I'm telling you in advance what is my trading plan for USD CAD. Now let's go to USD NOK. I said it many times, if you want to be long something against the dollar, especially from the commodity currencies, that has to definitely be the USD NOK. Why is that? Because simply the NOK has been one of the best performing commodity currencies against the dollar. So just compare it to the USD CAD and you'll see this huge difference. The CAD is pushing to new highs. After one leg higher, it gave us another leg higher without even pushing to a new low. And oppositely to that, the USD NOK pushed to a new low and has just formed a triangle. As we know, this triangle might have already been completed, actually, depends on how you draw it. And as you know, triangles are continuation formations. They are formations that, in the vast majority of the cases, they will break in the direction of the previous move. Of, you can call it the short-term trend, if it depends on what kind of time frame you're looking for. So, a push to new lows is my preferred scenario. An alternative scenario, when while we were still in the triangle, as I had said, was to push, a little bit higher as well, to perhaps form like an ABC. But it looks like probably that's not going to be the case, and this is going to be a breakdown from a triangle. So it's a market that remains quite bearish, and I think it's a great opportunity to participate.
On the treasuries, where you were saying it was anemic, and we're pushing new lows now.
Yeah, I mean, that was an easy call, because sometimes if you try to take emotion out of it,
right,
you just have to read the price action, and the price action here was extremely indicative of anemic. Something that, anemic, but which, by the way, is a Greek word.
That's why they invented geritol. That's not that's not Greek, is it? Geritol.
Geritol? How do you spell that, and what does that mean?
It had iron in it. It's an old thing that people used to take for anemia, iron poor blood. Geritol, Geritol, and that's what they used to call old people, the geritol generation.
I can tell you that Geros, which would translate to like GERO, I mean, is old man, but
okay.
I don't know.
All right.
Might have some connection, but can't promise that. Anemic comes from the A, which is like opposite, and anemos, which means like without wind. That's how it comes. So it's without wind. You know what I mean?
Yeah. We will diverge at new lows, though, I've noticed. And I follow the TLT, and the TLT for some reason isn't making new price lows. Maybe it will today, but it's a 20-year ETF.
Yeah, I know the TLT. It's a 20-year one. But as I said, I really wanted to see like a strong rebound here, perhaps towards the 123.20 area, but it's not here. I mean, the price action says that we ran out of fuel just before we even like started, right?
Yeah.
Doesn't look good. I mean, it looks to me like it just wants to keep pushing lower. And something else? Just look at the RSI footprint here, right?
Yeah.
Just look at it.
Yeah, confirm low. Yeah. Oh, that one.
Not only that. I mean, we just got a little small move here, but enough.
Went to neutral.
Yeah, but enough exactly to overcome the oversold conditions that we had here. So I really don't see any real reason why the next move is not going to be something like that, right?
Yep.
So bottom line, the most probable interpretation is that this little move here was simply a bear flag.
Anyway,
okay.
some people are probably tempted to bottom pick it, and there was a little rally. And what a lot of people don't notice, Steve, and I know you've done it for me, is if I have an idea and then I hear your work, and I think twice about doing it, and I don't do it, and if I had done it, it would have been a negative trade, and they never show up in your account. Avoiding a bad trade. And it's so important, but people don't think about it because it doesn't show up in the numbers, although it would. Very critical.
That's why one of the usual adages in trading is that having no position is a position. Why? Simply because what that means is that if you don't feel comfortable about something, staying away from having a position is likely staying away from incurring a loss. And that's something that, as you said, it won't print looking backwards in your P&L, but in essence, you did save your P&L from incurring a drawdown without a reason, simply because, in my opinion, you should not be trading when you don't have high confidence in something, right?
That's a pearl.
Why would you want to do that?
Only action junkies do that, and I advise them to go play a slot machine.
Yeah, this is one of the reasons, one, not the only, that I decided, after like one and a half years of trading that, doing short-term trades is not my style. Simply because when you're doing short-term trades, it also puts you in the mood to be looking for trades more frequently, right? Because your trading style is a trading style that, requires more frequent trading. So in essence, for me at least, that's how it worked for myself. Being a short-term trader also put me more often in positions that I shouldn't be going into.
Some people are humanitarians and they want to make their broker rich, Steve.
I'm one of these guys as well, because I'm making my brokerage as well. I mean, when I saw, when I saw like how much money I've given them to overnight, rollover costs and like spread within 3 years, I was like, oh. But okay, still, they're making money, I'm making money, so I can't complain. Okay, let's have a look at a few more things. I know that we're going to have a question for that, so let me have a look at the metals. Although I have to tell you in advance that what we had said about gold is still the case. I mean, I'm viewing this, let me draw it also, perhaps like a big choppy consolidation. If that's the case after this move higher, then the chances of a resumption higher have increased, right? But still, this remains too wide of a range and too choppy for my taste. So that's gold. Now let's have a look at silver. Also, quite choppy, a little bit more bearish than gold. It retraced more. Still a possibility of a large inverted head and shoulders formation. But for that to prove to be the case, we would need to see, silver catch up a bit, because if it gets prolonged more here, then the potential symmetry of the two shoulders will have been completely been lost, and then you stop liking it as a potential inverted head and shoulders formation. So if that proves to be the case, it needs to do quite fast. So we need to see a move higher, a retest of the neckline, and finally break above it. The neckline is approaching now, because it's a little bit descending, is approaching now roughly the 1750 area, but we had this high here at 1770. So let's roughly call it 1770 as confirmation that something bigger, something a lot more bullish is brewing for silver. Until or unless we get that happening, at best case scenario, what you can say is that silver has been in a very choppy environment for like a big period of time. I mean, since before 2017, actually. So, you shouldn't really commit to it in the longer term. Now let's have a look at my favorite, palladium, as well, which I'm happy to say that everything else is rebounded, but it's not. I'm still holding half a position here as well. And I'm still hoping for a push towards, the 900 area, because as you see, other things against the dollar are rebounding, but look at palladium. It hasn't really managed to catch a bid. This looks to me more like a bear flag than anything else. So, I'm still holding half of my position here. I took profits in the other half at 1,000, and, it feels good. It feels good, especially how much it's diverging from other metals. I mean, it tells me that, I'm not so happy that I didn't get limited out of the other half of my SPX position, for example. But on the other hand, I'm happy to still have exposure in palladium.
Steve, they used to use platinum in catalytic converters. Are they using palladium now?
Yes, that's true.
Okay, so maybe the weakness in palladium is a lot of people are saying that these tariffs are going to hurt certain automobile companies. So maybe less demand for palladium for catalytic converters. Just something I thought of.
Might be the case, but if you see the sell-off started from this high, started quite a lot, a few weeks before we even had the announcement about the tariffs, right?
Yeah, so did Carl Icahn liquidating a big stake in a company that would be hurt by tariffs. So people knew it. Some people knew in advance.
Really, what a surprise, eh? What a surprise!
Yeah.
First time it happens.
Yeah.
Yeah.
It's not what you know; it's who you know, isn't it?
Oh, absolutely. Because who you know will also give you information about. Will also shape what you know. Yeah, exactly. Let's have a look at copper as well, because I had a question on copper the other day, but we didn't have time to complete it. Listen, nothing has changed with copper, obviously, and we've said this many, many times. You can never be sure of a structure of a corrective move, but after seeing as much as this, you can be more or less certain that it is a corrective move, and that's the case with copper, right? You can see it. It took so little time to get from here to there, and so much time to just more or less consolidate the gains. In this case, though, we retraced quite enough of price as well. Bottom line, I remain constructive on copper. Doesn't look like it actually wants to roll over and die. Looks more to me like it took its time to consolidate its gains, and most probably it's going to be pushing higher once again. So that hasn't, my view on copper 100% has not changed. And now let's have a look at crude as well, because simply crude, we drew this the other day. We said, if it holds this little zone, the chances of directly pushing new highs is increased. If we break below that zone, then perhaps we are going to get one more leg lower towards the 55 area and then push to new highs. So obviously the chances that we're going to push to new highs from here have increased because it's holding quite nicely, but still we don't have 100% confirmation. So still the potential for one push for one lower low is not out of the window, but it has decreased as a possibility. Okay, so there is not a question. I never doubted my bullishness here in crude. The only question that remains is if it's going straight to new highs from here or from somewhere above 55. Okay, that's my view in this market. Hasn't changed. Most probable, as I said, from what we're seeing here, the possibilities have increased that it's going to push higher directly from here. Okay. Okay, let's have a look at a few questions because we don't have much time. Who do we have for an interview, by the way, today, Dale? Dale? Euro yen. Okay, let me go through the questions. The first question I see here is the euro yen.
Steve.
Yes, Steve.
Hey, we have today we have John Butkowski, a guy whose Twitter handle is Captain John Charts. He's a pretty good guy actually, from what I hear. So it's going to be interesting. Perfect.
Very nice to hear. In the vast majority of the cases, we have very nice interviews. I have to admit that Dale has been doing an amazing job booking people. Most of them are like, great people to interview. So we had a question about the euro yen, and the question is what happens from the euro yen here. I can tell you one thing for sure is that first of all, yesterday's price action was very bullish. Why? Because it was a Monday. It was the first Monday of a month, right? And what did we post? We posted an outside white candle and the Marubozu closing white, actually. We closed right at the highs. So, yesterday's price action was very bullish. But as we speak, we're testing like some very important resistance. Why? Because this area was a support area for a long time. The 200 DMA is also here. So, I wouldn't turn like outright bullish unless we break above this area. Because if we get rejected from that area, we have no reason not to remain bearish. If we do break above this area, though, things become more complicated, right? Because yes, we will have seen like quite a strong leg lower on one hand, but on the other hand, what are we going to get? Are we going to push to the next zone and then one more leg lower? Quite likely, I repeat. But can you exclude the possibility that this was, what we're going to see as a corrective move and that was it? No, I can't exclude it. Although the scenario that we're going to rebound a little bit higher and then push once more at least to the downside is my preferred scenario, right? So if we don't get rejected from there, I'm going to be looking towards the 134 area for a rejection and a push to new lows. So that's what I see having to do with the euro yen. Let's see though, because we have more questions. Any thoughts on yen? Commodity pairs. Oh, yen commodity further downside. Let's have a look at it. Let's have a look at them actually, because you're asking about the yen commodity currencies. Let's have a look at them. Okay, so listen, Aussie yen looks quite nice for a rebound. Why? Look where it rebounded from. We had marked that zone like a long time ago. So does it look good for more of a rebound? Yeah, it does. But keep in mind that having broken below this trend line, I will be most certainly viewing any move to the upside as an opportunity to be short. So I'm not surprised at all that I'm seeing a rebound higher, but I'm going to be a little bit surprised if this rebound at some point doesn't fail for another move to low. So first area of resistance, we already tested it today. It's this one. Let's call it 83.30. Why? Because, we had some lows here. So first area of resistance here, if we break above there, I would be looking for this area as resistance. And after that, I will be looking for the 86 area. But to be honest, this is not a place to be short anymore, right? In the short term, I mean, because, we had strong moves lower and at least some relief rallies are, quite expected. Look at the Kiwi yen as well. Same deal. Found support in a very nice support area. It was like a confluence of supports. It was this descending channels support. It was also this horizontal area of support, and it's rebounding nicely from here. Kiwi yen also found resistance today, and it remains to be seen what it's going to do from here. Wouldn't surprise me to see like a stronger rebound before failing once again. But it wouldn't surprise me to see a stronger rebound first. Now let's have a look at the CAD yen as well, which was the worst looking one. So CAD yen, that's what we drew last week, and it seems to be playing out very nicely, that at some point soon we should be seeing a rebound, but any rebound towards the 84.50, 85 area should be considered a good selling opportunity in my opinion. And so, I'm not even touching the chart exactly as I drew it. This is, this remains my opinion. So deeper rebound, stronger rebound, quite likely, but undoubtedly I'm viewing it as a selling opportunity. This move lower is 100% impulsive, 100% impulsive. So I have no reason to be looking to buy and not be looking to sell at better levels. That's what I think. Cryptocurrencies fall after South Korean ban on government trading. Yeah, and I was actually looking at those just before. Let me show you. Bitcoin is 5% down. Ethereum is like 3% down. I have to say that between Bitcoin and Ethereum, Bitcoin looks quite better. You can see here as well why. We had a stronger rebound, and we've broken out of this channel as well. But let's be honest, to confirm that some type of bullish behavior has re-emerged in the market, I would really want to see this horizontal area break to the upside. Until or unless that happens, at best, I remain neutral. Okay. Same deal with Ethereum, more or less.
Yeah, they've been heavy. I thought Ethereum and Litecoin have been heavy while Bitcoin's been going up. So I don't know. I'm not impressed with Bitcoin either. So anyway, we do have an interview now.
Yeah,
Since you're on cryptos.
give me just a second. We have a question from Martin saying that yesterday I said that perhaps this move higher, these three candles were a bear flag. If today's move invalidates that, no, it doesn't completely invalidate it, but it definitely increases the chances that we found a tradable low. As I said before, Martin, technically it would not surprise me at all to see more weakness in cable towards the 136 area, but the more we rebound from here, since we've seen a new low, I have no reason to persist that we might go to 136. You know, the market is not always trading in a perfect way, so you know, we might just head to new highs from here. What would confirm that for me is probably a daily close above 140 once again. So if I see a daily close above 140 once again, I will consider that the chances that we're headed above the 143.50 high are, you know, very high. Okay, thank you, Dale. Enjoy the interview, and you know, sorry for not getting through all the questions. We had quite a few, but we'll be here tomorrow as well.
Thank you, Steve. Okay, John Butkovsky. How are you, John? I'm going to make you the presenter now. I want to thank you in advance for taking the time to be with us today. Should be hearing your voice and seeing your screen shortly. Captain. Calling Captain John.
Dale.
Dale?
There he is. Hi, John.
You there, buddy? Hey,
I can hear you, bro. Good morning, my trading warrior. Good morning, my trading warrior brother. How are you today?
I'm doing great. How are you?
Good. I love the Twitter handle. You know, I say to people, we're all captains of our own ship. And you're Captain John Charts. So, you know, John, I know that you're an RIA now and you have different services. It's always fascinating to me and our audience how people get from point A to point B and finding out what it was like for them in the early stages of their career in trading. Can you tell us a little bit about how you got started, who introduced you to it, if you had mentors, etc.?
Right. Well, everybody has a story, right?
Yeah.
I started out, I've been telling people it's 95, but it's actually 1994. And so that's long ago. But I can tell you, when we filled out our tax returns, your occupation was stockbroker, okay? So I got into business. I come from an engineering background. I decided, I fell in love with the market. And of course, I didn't know anything about the market, but I still.
Why do engineers? And you know, when I was a commodity broker, they were my best prospects. Why do engineers gravitate towards the markets? Could you answer that?
Well, I think I can. I think the reason is I've done quite a few presentations, and typically anybody that's mathematically inclined will look at the presentation and go, "Oh my God, I got it." Okay. And I'm not, not to be biased towards that group, but I think it's when you start looking at technical analysis, I think a lot of the engineer types just gravitate toward it. It makes a lot of sense to them.
Okay.
Especially when you start going into things like Fibonacci and so forth and so on.
Okay.
But anyway, I didn't know. I really didn't know what I was doing, even though I went through trading and got all my licenses and everything. And I probably went through building my business, the first year and a half, 2 years, mostly was selling muni bonds and mutual funds, and eventually people wanted to do individual equities. And once again, I really didn't know what I was doing, so I relied on the wirehouse research, which I'm sure this would be no surprise to you. It got me absolutely nowhere, and I got very frustrated to the point I was ready to leave the business. And the firm that I was working at the time was Dean Witter, which became Morgan Stanley. And my manager was kind enough to say, "Hey, listen, don't give up. There's this guy we're bringing back to the firm. He started technical analysis in the early 50s, and the guy is incredible." Well, Well, that was my start. I started following this guy, and
Who was it?
his name was Lou Smith, and
Okay.
Lou was great. No one really was amazing. He was probably the best resource in the firm, but nobody listened to him. You know, none of the advisors listened to him. Really, they didn't know about him, or they didn't know what he was talking about. And he showed me the way. He was a big picture guy at the beginning, and then he would go through, into what's working in the market, sector rotation, and where the relative strength leaders were. And
He was your teacher, John. He was your mentor.
Absolutely. He was my mentor. And I love the guy because I could call down to Times Square, and I'd get directly, he'd pick up the phone. All right, because nobody else listened to him. So he talked to me in Portsmouth, New Hampshire. So we became friends, and I eventually did get to meet him and have lunch with him. But he introduced me to what's known as point and figure charting. And
Oh, yes.
I had
X's
no
and
idea.
O's.
Yeah, I looked like a tic-tac-toe board. I had no idea what he was talking about. I had bought, I think at the time, one of the first stocks I bought was Intel, and it was around $50. And it just, I had called him, and he said, it looks great on a chart, and our fundamental analyst had a target of 60. In a matter of a couple of months, it went up from 50 to 60, and I called him up and I said, hey, should I sell it? And I said, to hit the analyst target. And he said, I don't know what that analyst is smoking, but that thing's going to 90. I'm like, what? So I held on to it, and it did go to 90. And I said, geez, how did you know it's going to go to 90? And he explained to me what a vertical count was. And so that was my kickoff into charting. This was originally the point figure charts. And then I just ended up pretty much self-taught, learning about candlestick charts and all sorts of other things. And,
yeah, a lot of floor guys, a lot of floor traders use point figures. They'd have their clerks plotting the X's and O's and give them signals when they'd have a change. So it's kind of a lost art.
It is. And when I went to my manager, I said, hey, you know what point, again, if it was 90, probably 96 at this time. You know what point and figure charts are? He was like, oh my God, I haven't seen one of those in 25 years. So it's been around. I believe it has its roots in back to the days of Charles Dow. So yeah, it's been around a long time. And if there's one thing, if you did nothing else but at least learn that, I think you put yourself in the top 15% of money managers / investors.
Okay. So here we are now, Bill, and the markets have become a little bit more binary. So I'm very interested in taking a look at some of your technical work here. You have both a newsletter or signal service, plus you're a registered investment advisor. Is that your business model? You have two of them?
Exactly. We have both.
Okay. Okay.
And that's great because some people have a 401k, right? And they can't turn it over to be managed, so we provide a service for them as well. Or some people want to, make some decisions themselves, and the subscription service works out best for them.
Okay. I did notice on your RIA that you have discretion, power of attorney, so that you can make changes to allocation or sectors. Do most registered investment advisors have to call their client before they make any changes to their portfolio?
I would say, I don't know the number on registered investment advisors, but I would say in general, probably 99% don't have discretion. And I'll tell you, I'm glad you brought that up because this is a very important point. In order to do what I do and what others like me do, you need the ability to be able to act on the behalf as a fiduciary for your clients. And what does that mean? What that means is I don't have to pick up the phone, Dale, and call you, and you're in a meeting, and then you got to call me back, and then I got to call you back, and
then it's gone. Right?
It's gone.
Yeah.
Well, by the time I get in touch with you, it's probably time to get back in or get back out, right? And then and the other problem you have, which I was frustrated with, is that who do you call first? What if you have 100 clients? Do I call the biggest client first, the smallest? Do I call my best friend? Do I call, So it causes a lot of conflicts. when you have discretion and you're not doing it on a commission basis, you're doing it on a fee basis, you put yourself on the same side of the table as the client. So say, for example, we buy XYZ in a certain model, everybody gets that product, same percentage, at the same price, at the same time. And I was, pleasantly surprised that when I started doing discretion in 2003, that almost everybody wanted it. They didn't want to be really involved necessarily in the day-to-day, week-to-week communications and making decisions or approving decisions.
And then you'd have to go through explanations. Why are you doing this? And
right.
I remember being, when I would prospect for accounts, that perhaps I'd see a scenario that was fairly imminent, and my prospect would say, well, you know what, I have to talk to my accountant, or I have to talk to my wife, and I would say, well, you know what, let me call the exchange and ask them to halt trading until you make a decision. And they would say, John, oh, no, Dale, you don't have to do that. They didn't want me to halt the markets for them. Anyway, so, we've had a lot of two-way action. Are you enjoying the fact that now indexes are more binary than a one-way street? And I'm curious as to what's on your radar in different instruments or indices.
Yeah, well, to answer your question, obviously it's a lot more fun when you have a one-way market in the sense that it's easier to me, it's easier, at least for relative strength strategies. First and foremost, I'm a buy high, sell higher, but there's times that doesn't work. We all know that. So here we are in a market that seems to be a little more range bound, something in it for everybody, right? The longs, the shorts. And for me, it's good for my business because it people become too complacent when things are going one way, and they know that they think they know. It's the old saying, confusing bull markets with a brain, right? So I do enjoy having a market that's a little tougher to navigate, and it's just better, quite frankly, for us to get new business. So
what are you seeing in here, John? We had the initial break in February, a huge recovery, sell-off last week, and we're rallying to retest last week's highs. Well, not last week's highs, but recovery levels. So okay,
right.
This is your.
Well, in some cases.
Okay, go ahead.
Some cases we took. I was just going to say, some cases we did take out the January highs, but probably for most of the major indices we haven't.
What, like Amazon has? Some of the FANGs have made new highs?
Right, Netflix, exactly.
Okay, yeah. Okay.
So, well, right now, the way we were looking at things on a longer term, and I'll show you that in a chart here in a second, really don't see any change in the big picture of the market. And the way we run our analysis is the first thing we want to do is we want to keep tabs on where the money's flowing. In other words, is the money going into U.S. stocks? Is the money going into international? Is it going into bonds? Is it going into commodity? And once we figure out where the relative strength is in the asset class, that's when we start digging down inside that asset class.
I love your maxims.
Thank you. Man, I haven't heard that in a while, maxims.
Especially the one that's toughest for everyone. You don't always have to do something.
Oh, well, that brings me to another thing. And what was your guest prior to me? Was that Steve?
Steve Volge? Yeah.
Yeah. Well, he made me think of something. I had to add another chart to my presentation here. Can you see the chart right now? I'm sorry, the presentation right now?
I'm seeing the break even and the loss.
Yeah.
Yeah.
Right. All right. So the one thing I didn't tell you is I played Division I football, and I know that doesn't make any sense being an engineer, but I did. And
let me ask you, where is Northeastern University? It's familiar to me.
Yeah, Boston, Mass, downtown.
It's where?
In Boston, Massachusetts.
Oh, okay. Wow. Okay. What position did you play?
Inside linebacker.
Okay. You know, we have a team here, and you know what I've said? Like, you know, I was had a bad night and I was ill. Don't you agree that a good team always fills the hole? A good
Absolutely.
line always fills the hole, doesn't it?
Absolutely. And I also, I would also say a great defense doesn't lose games.
You're okay. Great metaphor, Pearl.
So
yeah, I see your first maxim. That's what I was talking about. Never lose money. Don't forget. Never lose money. Buffett.
Right. Yeah.
But he does.
Well, you know, Steve got me thinking. You know, this is true. This happened multiple times over the years. And I'd run into somebody and they'd say, "Oh my God, you know, like, let's go back to the financial crisis, right?" And you would hear from somebody, "I cannot believe my portfolio went down 50%. My God, I'm going to have to go up. I'm going to have to go up 50% to get back to even." And I'm just looking at him and I'm going, "Wait a minute, you're a sharp guy." No, if you go down, I don't know if you can see my cursor here, but you need 100% to get back.
Yeah.
Right, exactly. And I said, well, what about we go back to the .com? I mean, there's plenty of stocks that blew up in 90%, right? Well, if you go down 90%, you got to go up 900%. And people are just like, "Oh my God, really?" So, you know, I look at things like, I don't consider myself a gambler, so I look at things from a standpoint of playing defense and trying to keep your losses at a minimum. So we're all going to have losses. That's part of the game. Is paramount, right? To your investment success, to the point that it's probably even more important than worrying about how you're going to get your alpha. So I wanted to throw that slide up because a lot of people don't realize. I love the one that's, you know, if you lose 90%, you got to go up 900%. That's ridiculous. So,
okay, and even though you're trading equities and maybe ETFs, you don't trade mutual funds for your clients. What are the main instruments that you trade for your managed accounts?
For the managed accounts, it's stocks and ETFs.
Okay.
Primarily.
And you're 3-to-1. You won't take a trade unless you have an RR of 3-to-1.
That's correct.
Okay. Great rule.
That's correct.
And your chart.
I like to see 5-to-1, but you know, 3-to-1 is acceptable in most cases. So anyhow, with that said, let's get back to managing, you know, losses. If I could share one thing with me, you know, a newer person, is a very simple thing you could have done. One thing you could have looked at over the past, 15, 20 years that would have kept you out of getting your head chopped off in 2000 and 2007, 2008 was to follow this. The chart I'm showing you right now is the S&P 500 going back to, I can't see my glasses, back to like 94. It's just a plain, simple moving average crossover system. And if you follow the
6 and 10 day,
it's a 6 and 10 month in this case.
10 month. Okay, they're monthly.
Yep. So it's long term. It's, you know, but it's just keep in mind, it's not. You may not be the one that's going to be sitting here waiting, you know, a couple of years to make a trade, but it's just to give you a big picture view of how you would have been helped. And I will go through it. You'll see the yellow highlights when different firms and different authorities told you to get into the market and told you not to be in the market. And obviously they were wrong every single time, so don't listen to the news. But if you'd gotten in when the green line crossed above the red line back in the early 94, 95 time frame, had one heck of a run. You didn't have to really do anything buying the major U.S. markets until it started to roll over in the first quarter of 2000 or so, and you see that the green line fell below.
Yeah, it got you out pretty good. It gets you out
pretty good, right?
Yeah.
Right. Didn't get you out at the top, but it got you out enough that you didn't have to suffer a 35, 45, 55% loss, and then it put you back in 2003, which was great because that's when I got my discretion, and I was scared out of my mind starting out in the business when things were in a couple of year tailspin. But just watching this, I don't want to take up too much time on it. You can see that it took you out of the dot-com crash, put you back in, took you out before the financial crisis, put you back in, and the only problem, if you want to pick on it, is over here on the right. You did get whipsawed a couple times, but it's not a really big deal. So, getting back, we use moving averages, we use relative strength, and a number of other tools to help guide us into getting alpha, trying to have outperformance when we have a good market, and also to play defense. And I love what Steve said. Cash is a position, right? I mean,
yep.
if you're RIA, if you're advisor, or you're doing it yourself, and you go, people say, well, geez, if I go into cash, I'm not going to make any money. Well, yeah, but if you're in a position where the best thing is cash, you better darn well be concerned with return of your equity or your money than your return on your money, right? So
yeah,
that's how we're looking at it.
I like that one. Return of capital rather than return on.
Right on, Bennett.
Okay.
So we know going in for the past couple of years that the U.S. market's been the place to be. International market's been in second. And we can go down, into commodities and bonds and cash and currencies in terms of, exchange traded funds, sector funds, things of that nature. So the NASDAQ 100 is really been a hot spot. And if you dig under the U.S. markets, under the S&P and the New York Stock Exchange, and this is just showing a relative strength chart, a price chart, and a relative strength chart here of NASDAQ versus the S&P 500. So what we like to do is go top down. So U.S. market first. Well, what's working in the U.S. market? Is it small caps, mid caps? Is it NASDAQ type stocks? Well, in this case, it continues to be NASDAQ type stocks.
I saw something interesting that I didn't know on CNBC yesterday, that European bourses indexes on average only have about 15% technology weighting compared to over 40% in the U.S., which could be a major explanation of the U.S. outperforming Europe.
That's interesting. I did not know that.
Yeah, I thought I'd share it with you. So they're very lightly weighted towards technology in the European markets.
Good to know. Thank you.
Yeah.
Well,
I thought it was more currency, or the economy wasn't as good, or problems in Europe, but it's actually part of it has to be, at least because of the performance of FANG and tech stocks, that they don't have as many companies in their indexes that are technology based.
Exactly. Well, you bring up a great point. Is back. I wish I held on to this report that I had. I don't know what happened to it, but back in, I think it was 98. The NASDAQ was it? It might have been when long-term capital blew up, or it might have been, I can't remember. But anyway, there was a pullback in the NASDAQ about 30% plus, and the NASDAQ came right back. And the NASDAQ ended up being up like 38% for the year. But most people that had a portfolio that looked like NASDAQ were down for the year. And, you go, how the hell is that possible? How could you have a fantastic, 5-star fund that kind of mimics NASDAQ, and it's down, but yet the NASDAQ index up 38%. Well, what made it happen is if you took the look at inside the NASDAQ, it was 10 stocks that had it up 38%. If you took out 5 of those 10, it was like only up about say 7%. And if you took out the other 5, it went negative. So it was a very small piece, kind of like what you're seeing with FANG and some other things right now.
Yeah,
There was
so
a lot.
we're seeing that type of concentration now, aren't we? Does that make you nervous?
Yeah. Yeah, it does, because, one of the things we watch is the advanced decline line. And the advanced decline line could be a great indicator for a precursor of what's to come. Often it will turn down ahead of the market indices turning down, and vice versa. It tends to turn up before the market turns up. So, and 80 lines like that is not in trouble right now, but it has been kind of flattening out, turning down a little bit, which is indicative of fewer and fewer participants. The old saying is, the generals, the soldiers have turned around and run the other way, and all that's left is the generals, and they're going to turn around and look and go, uh-oh, we're out here by ourselves, right?
When the troops retreat, the generals get slaughtered.
There you go.
Yeah.
I love that.
So are you seeing that now? Is that what this chart is? XLK?
No, this is just digging into NASDAQ, which you mentioned is heavily weighted in tech stocks. So here we go from NASDAQ. What's making NASDAQ work? Well, this is the XLK ETF versus the NASDAQ 100. Just another relative strength chart. You see it's going up left or right. That means technology is outperforming the NASDAQ 100 in general. And one of the things we did, we take it a step further. We go down to the chart analysis level. So we use line charts, we use bar charts, we use candlestick charts. We're very familiar with using different patterns. In this case, we had Microsoft a while ago as a core position, because one of the charts we love is a massive base, and I'm sure you know who Luis Yamada is. And she had I think she coined the phrase, the larger the base, the farther into space, something to that effect.
Yeah, that was
we had this big, what's that?
That was my saying.
Was your thing? Beautiful.
Yeah.
I did not know that.
I have no
She stole it from you.
Huh?
She stole it from you, Dale. She took it from you. Well, Microsoft had a monster base, right? 15 plus years. It finally broke out, and I did an update for us here. Let's see, come on. Oh, not too far. And you can see that on the very bottom, you see that gray line chart is showing Microsoft versus the NASDAQ 100. It began to break out in relative strength in early 16, and then we got the breakout on the multi-year base, I believe at the end of 2016. And so here we are, about 13 months, call it 14 months later, and we have Microsoft up, I believe, just over 60% from that entry.
Yeah.
So
yeah, because it went nowhere. It went nowhere from 2000.
Right.
Yeah.
Exactly. So it woke up. It came out of its hibernation.
Old tech, because people were calling it old tech.
Right.
Yeah.
Well, hey, a lot of us starting to wonder if we were ever going to see new highs out of some of these things in our lifetime. So we finally got on Microsoft, and I granted, 60% return in 14 years may not be exciting.
I don't think we'll ever see split adjusted reverse splits that we had, and I don't think we'll ever see a new all-time high in Fannie Mae. What do you think?
Oh, well, how about Citigroup?
All right, so
I had somebody say to me, well, look at Citigroup's coming back. It was at 60 at its all-time high, and I'm like, yeah, but don't you remember didn't it have like a 10-to-1 reversal or 15-to-1 stock split reversal? I go, it's still
quite a few. Yeah, I think more than one.
I'll be 6 feet under when that thing gets back to 60.
Yeah,
that's for sure.
Yeah.
So we're going to show just simply, how we work our way down from the big picture, down inside that, and then to the sector, and then to the individual equities. I threw a picture up here of Intel just to kind of show another one that broke out of a big base, in this case, a head and shoulder continuation pattern. And I just want to take a moment to talk about the model portfolio that we have, the X model, which is available to clients. We use Fidelity to custody our accounts in our RIA business through Capital Markets IQ, and that's also available for subscription services for folks. And in either case, I mean, we're at on the advisory side, we're acting on there for clients is what we're sending out the signals on the subscription side. So we get you covered.
Okay, what's your minimum account size for RIA?
For the RIA, well, we prefer to have at least 50,000.
Okay.
Just makes it easier for us to move around. I mean, there's technically, I guess you could say there's no limit, but that's what works best for the size of the portfolios we run and the types of things that we buy.
Okay. And your subscription service, you have different levels?
Yeah, right now, well, we do have the flexibility to do customized portfolios. For one, I should mention that.
Okay.
And right now, the most popular is the X model, and we have a professional version, or also one that we use with other registered investment advisors. And we also, this just quick shows the timing model that we have in blue, and how we try to avoid drawdowns. And did I miss it? Oh, I did. I went too fast.
Okay. Yeah. Well,
this is a 20
massive 20, performance.
Yes, massive outperformance. Drawdowns are minimal. That's the backbone to what we're trying to do here. And
what's your worst drawdown? What's your worst drawdown, John?
Worst drawdown, top to bottom, was 21%.
Okay, how do you manage yourself during a drawdown? Because I think that's where the rubber meets the road. Because that's when most people blow up. They increase leverage, they change methods, they revenge trade. How, now that you've been doing it this long, what kind of self-talk do you give yourself when you're going through a period like that?
Well, on the one hand, I pat myself on the back for not going down 60%, but we all know you can't eat relative strength, right? So that drawdown happened in 2008, and it was more from finding good risk reward setups that just got taken out and we got stopped out. Okay. And so it was, it was more of a death by 1,000 cuts.
Okay, so you use hard stops on your positions, or
correct,
end of day and then you get out. Hard stop?
Right.
Okay, because have you ever used mental stops?
Yes, both.
Okay, the last time I used a mental stop, my first stop was a mental institution.
Oh gosh.
All right, I had to set myself up for that. Okay, so all right, so here's your subscription service, right? The 48 and 98.
Right.
Okay.
98 more comprehensive, more one-on-one, availability for questions, more videos, etc. It's a tuned-up version of a $48 subscription.
Okay. Well, John, I want to hear one Nostra Butkovsky. Where do you think the market's going to be in July? New highs? New highs, or okay, let's do this. Forget about the time. Are the lows that we had at the 200 moving day average going to hold or be taken out?
I think they're going to hold.
Okay.
I think they're going to hold. I think if they don't hold per se in terms of I think there's a possibility to get pierced, intraday, intra-week.
Yeah.
I really, the only thing that concerns me, there's a couple of things that concern me longer term, but not enough to get, to start leaning more on the bearish side. But, our moving average systems are all still in a bullish configuration. And, you think about it in a long-term perspective, we have broken out. You think of the major market and you look at the highs in 2000 and the highs in 2007. We've taken those out. So, I don't rule anything out. This could be the beginning of another big bull market. I'm not a super bull or super bear either way. But I think we're.
Okay. I once had a Skype conversation, and you were talking about gold shares. A view on the shares. I noticed yesterday when gold was down, the shares had a little bit of a heartbeat. Do you like the miners?
I do. I have not been following them as closely recently. I know that, and this was my analysis, so I do know that from a sentiment standpoint, that whole group is starting to look very good. Maybe you could comment on that, since I know you do a lot of that. I heard that commercials are pretty short, I guess, on the metals, and so forth and so on. So I think there's a pretty set up sentiment-wise, and I know the charts on the stock look pretty good too.
Okay, John. Thank you so much for your time today, sharing your journey and some great maxims and pearls. You're a natural teacher, so I wish you and your team and your clients continued success throughout the year, and it's a pleasure meeting you.
Hey, so, pleasure to you. I appreciate you having me.
What's that, John?
I said I appreciate you having me on.
Okay, I had a great time with you, and hope you enjoyed being here, and let's get back together down the road, okay?
I'd love to do that. Great.
Okay, everyone. And the best way to follow John is you could follow him on Twitter at Captain John Charts, and here's his information right here. You could email him, and the name of your website is CaptainJohnCharts.com. So check him out. With retirement money, IRAs, he can take it all, and he's definitely going to be defensive for you. So again, good hunting, John, and I'll talk to you.
All right. Thank you, Dale. Take care.
You're very welcome. Thank you, Face. See everyone tomorrow. Good hunting the rest of the day. And remember, most of all, don't just count your pips, count your blessings. We'll see everyone tomorrow for our Wednesday session. Adios.